get straight into a look at the economy. As I was saying a little earlier on in the show, we've got quite a few data points expected this week. What specifically will be standing out for you?
Hi, good morning. Yes, kicking off quite a data-intensive week this week will be retail sales tomorrow morning. We forecast retail sales for the month of October slowing down to about 4.1% year on year from about 4.3% year on year in September. And we're likely to see the drag in retail sales emanating from non-durable goods, which unfortunately have been bearing the brunt of quite a disproportionate inflationary profile, as well as durable goods, where the CCI released recently as well indicated that consumers are quite pessimistic regarding the appropriateness of this quarter to purchase big ticket durable goods items such as furniture, as well as a few other quite large appliances as well. So with having said that, consumer confidence did see a weakening in the fourth quarter to -3 points. Now that typically would be quite ominous for consumer spending as well as retail sales. So we see retail sales kicking off the fourth quarter on a little bit of a weaker foot owing to these factors.
Of course, one of the things that's exerted quite a bit of pressure on the consumer is inflation, and specifically, and we're anticipating consumer inflation data on Wednesday as well, Sibusiso. Your broad expectations on that front?
Yes, that's correct. We see CPI coming in at about 5.6% year on year on Wednesday for the month of October. That's unchanged from the previous month. Again, food pressures are likely to prop up this number, regardless of the fact that the fuel price in recent months has eased slightly. But with the high weighting of food in the basket, we are likely to see the inflation number remain propped up for the remainder, in fact, of this year in the final quarter. We do see it peaking in the first quarter of next year. The monetary authorities in the recent monetary policy statement have also indicated that their peak is forecast for 5.7% in the first quarter of next year. So while that's encouraging because it's within range, within the 3.6% target range, we do see upside risks emanating from the currency as well as from food prices.
Of course, that really puts a lot of focus on the kind of growth scenario that we're seeing in tandem, with this rising inflationary scenario as well, Sibusiso. And with that growth very much in focus as well, we've got manufacturing production numbers for October to consider. Run us through your expectations there.
Yes, absolutely. Manufacturing, we do see it slowing as well in line with the general economy. We've penciled in a contraction of about 3% from about 1.1% in the month prior. And that's largely going to emanate from the complementary industry, that is the mining sector, which is also likely to see a slowdown. The manufacturing sector owes quite a large chunk of its production to basic metals and non-ferrous metals and the like. So the slowdown that we're likely to see in manufacturing, again, we've penciled in around a -3.3% contraction there. We're likely to see that dragging from mining production. And mining production at the moment is bearing the brunt, of course, of industrial action. But the blow will be softened slightly by some base effects that we're likely to see. As you can recall, in October 2011, the PGM sector saw quite a sharp contraction to the tune of about -27%, owing as well to industrial action as well as some safety-related stoppages. So at the moment, while we do see a contraction in mining and that filtering through to manufacturing, the blow is likely to be a little bit softened owing to these base effects.
We've got the blow of local economic data seeming to be softened by the economic data that's filtered through on the global scene when it comes to the blow that's being dealt to the local units. So on Friday, that rand firming slightly against the dollar, some weakness coming through this morning. But overall, what's your outlook in terms of the trading range for the local unit, given the fact that we've got, yes, some positive trend emerging on the global scene, but certainly here in South Africa, an economy still under pressure?
Yes, that's correct. We're seeing the rand at the moment trading within the sort of 865, 870 range on the back of a slight risk on given the data coming out of the US last week regarding employment, and some hopes regarding a resolution surrounding the fiscal status of the US economy at the moment. But again, like you've rightly pointed out, the glut or the major influence regarding the currency will stem from domestic factors, and the economic growth outlook is likely to put upside pressure, or rather depreciating pressure, on the currency. As we've seen, the latest print came in that GDP actually slowed down to the point of 1.2% in this third quarter. And we do see that slowdown continuing somewhat owing to the fact of lingering effects in the mining sector, which actually contracted negative 0.6 percentage points to the third quarter GDP growth. So on the basis of these factors, Q4 is likely to also be one of sort of slow, low single-digit growth as well. And that's likely to play quite an important role regarding currency movements going into the final quarter of this year.